Hi, everybody. Well, it was one hell of a day today in the financial markets. Really a crazy day. And I'm not necessarily talking about the equity markets. I'm talking about the oil market. Um, I don't know if you weren't paying attention to what was happening in the oil market today. The front month, the spot month, was the May contract, and the May contract went off the board today. The May contract uh, expired today, or I think it expires tomorrow. I'm not sure technically. Maybe this was the last real day of trading in the May futures contract. And when the day started, I think the contract was just a little under $20 a barrel. You know, we got down to like $18 a barrel on Friday. I mentioned that in my Friday podcast. Anyway, the price started to collapse, and it eventually got down to below $1. And as soon as it was below $1, I was thinking, wait a minute, it looks like the price of oil is going to go negative here. I mean, we've got negative interest rates, so we might as well have negative oil prices. I guess that's not impossible. And no sooner did I tweet that out, but then the market went negative. And in fact, the oil market for May delivery settled, I think, at about negative $37 a barrel. The low on the day was negative $40 a barrel, not positive $40 a barrel where we were a month ago, but negative $40 a barrel, meaning that you didn't buy oil for $40 a barrel. If you had oil and you wanted to get rid of it, you had to pay somebody $40 a barrel to take the oil off your hands. So in other words, oil is like garbage, right? You have to pay the garbage man to come collect your garbage. Now, if you have oil, you got to pay somebody to get rid of it because, you know, oil needs to be stored. That is the problem. All the storage facilities are full. There is no place to put the oil. And apparently there's still a lot of oil on the way. You got tankers full of oil coming to the United States, and there's no place to put it, and there's no demand to use it. So the price of oil is imploding. And, you know, of course, one of the main reasons that we have so much oil is that supply and demand really wasn't working thanks to the Fed, because the Fed kept interest rates artificially low, and that enabled a lot of U.S. shale oil companies to keep producing oil, even though they were actually losing money on the oil. They were still producing it so that they can service their debt because they still needed revenue. And because interest rates were so low for so long, a lot of these oil companies stayed in business and kept pumping. In fact, they're still pumping, even though the oil they're pumping at this point is worse, not only worth zero, you have to pay to get rid of it. So again, this is the Federal Reserve had played a large role in the fact that we have such a glut of oil. And obviously the solution right now is to stop producing oil. The market is actually telling oil producers, don't produce any oil because the oil you're producing has a negative value because we don't need it and we have no place to put it. I mean, I don't know, maybe pretty soon people are going to start emptying out their swimming pools so that they can store oil, right? I mean, oil, a contract of oil is for 1,000 barrels. There's 42 gallons of oil in a barrel. So that means each contract is 42,000 barrels, which I think you could fit that in your backyard swimming pool. I think an Olympic-sized swimming pool holds about maybe 15 barrels of the equivalent of oil, I guess, could fit in there if it's the same volume as the water. But I mean, who wants to fill their swimming pool up with oil? You know, I saw somebody joking on Twitter that maybe we could use all of the empty WeWork office space to store all this oil. But the problem is, you know, you can't store oil in an office. I mean, you need a certain type of container to keep all that oil. So the prices collapsed. Now, obviously, the further out months are not down to negative numbers. If you look at oil for June delivery, oil is still $21.36 if you want to buy it for June delivery. The problem is that contract's going to expire next month in May. And I don't know, I would be pretty nervous if I was holding on to one of those contracts Because what if nothing has changed over the next 3 or 4 weeks? I mean, remember, all the oil that's out there, I mean, we're not really going to use it all up in the next 3 to 4 weeks. Who's going to take all this oil in 3 to 4 weeks? I mean, what happens if the same thing that just happened to the May contract happens to the June contract? That means you have a lot of risk from a positive 21 to a negative 40. That means you can lose $60 a barrel. I mean, whoever thought that you could lose more than 100% of the price of oil, right? If you owned a May contract yesterday and you thought, well, what's my downside risk? I mean, how low can oil go? I mean, could it go to zero? You probably didn't even think that was possible. Yet it went to negative $40 a barrel. You know, I can imagine too, some of the losses, even among hedgers. Obviously, speculators, you know, they lose money, right? You're gambling on the price of oil. You buy an oil futures contract. You have no intention of taking delivery, right? You're just a speculator. And now, of course, you're stuck taking delivery unless you get rid of your contract. Because if you keep your contract, you're going to get delivered. Because a lot of the shorts, right, they're just going to deliver that oil because if they don't need it, so they're going to try to deliver it because somebody ultimately has to take that oil. A lot of the speculators just figure, look, I'm just going to cash out. I don't want the oil. I'm just going to settle out. But now you have all this pressure because you have a lot of longs that, you know, or shorts that want to deliver the oil. They need somebody to take it. They need to physically deliver the oil that they don't need. So the speculators are losing money. But what about the actual users, the consumers of oil, who hedged into the market? They knew they needed some oil. And so they went out and they bought some oil for delivery in April, right? The May contract, they were going to take delivery and they thought they were going to need it. That was pre-coronavirus. Now they don't need it. They don't have any room to put it because they have more oil than they need because they're not using the oil they thought they were going to use. So what do? They don't want it. So now they have to try to sell the contract. They were planning on taking delivery, but now they got to sell it. Sell it to who? Nobody wants it. And so you're having to pay a tremendous amount of money to get out of these commitments. And so now people who thought they were hedging in oil are actually losing money on their hedges. I mean, it's one thing if you're speculating and you lose money. You're not supposed to lose money on your hedges. You're supposed to be hedging to reduce your risk, not hedging and then all that it's storing in a facility somewhere. What they do is they roll these contracts. And so this ETF is sitting with a bunch of contracts now that expire in a few weeks. And what if what just happened in May happens to the June contract? I mean, who knows where this thing is going to go? The price of this thing could crash well below $1 a barrel. I mean, a lot of investors are about to get clobbered in that ETF because they're rolling futures contracts. They probably don't even appreciate what they own or that any of this was even possible. But the bigger issue is, why is the market ignoring this? So the Dow was down just under 600 points today, 592 points. Of course, the oil stocks were among the weakest, but they were only down like 4%, 4 or 5%. It wasn't really that bad. And some were down less than that. I mean, the big loser in the Dow was Boeing, percentage-wise, was down 6.75%. But this is not that big a down day. I mean, we've had much bigger down days before, considering, I think, what's going on in the oil market. This should be a bigger down day. The S&P was only down 1.8%. The NASDAQ down 1.2%. That's barely down. A Russell 2000 only down about 1.3%. In fact, the banks, a lot of the banks are sitting on a lot of this bad energy debt, right? All of these oil companies obviously can't pay their bills. But I think we actually had no, not quite. It was about flat. I thought it was the index, the regional bank index was slightly positive going into the close. Ended up down a couple of ticks, about 0.25%. So barely a decline in the banking stocks. But given what's happening, the reason that nobody wants any oil is because nobody's using it. We're not going anywhere. People are staying at home. They're not going to work. They're not going out. They're not traveling. The planes aren't flying. So obviously, we're not using oil. I mean, we normally use a lot of oil in the United States. You know, going into default, the market would be imploding. The question is the Fed preventing the market from imploding or just delaying the implosion? Is it going to happen anyway, despite the Fed? Or, you know, is the Fed going to have to really step up the money printing and buy even more securities and actually start buying stocks. They haven't actually done that yet. They're buying the debt instruments of companies and they're buying junk bonds, but I don't know that they're actually buying the stocks yet. So they still have that, right? They can still pull that out of their butts, right, to start buying the actual stocks itself. And I wouldn't put that past them because they've already said they're going to do whatever it takes. So they're going to try whatever they can do to try to keep this house of cards from imploding. But of course, the more they try, the worse they make it, because all they're doing is printing all this money. And I know people are going to say, you see, this is deflation. You see, oil prices are crashing. This is deflation. This is not deflation. This is demand for oil going down. Remember, inflation has to do with the expansion of the money supply. But even as the money supply expands, right, to the extent that it pushes prices up, you're looking at all prices, right, the general price level. Now, as prices are going up, right, some prices could be falling while other prices are rising. So the general price level can go up, even if the specific prices of certain goods or services are going down. It just gets offset by the increases in the prices that are going up. So it's certainly possible based on changing supply and demand. If nobody wants oil because nobody is driving and nobody is working, yes, the price of oil can come down, but other prices can go up. And in fact, even when you're using oil, even if the oil itself is cheaper, right, you still have a lot of costs between the oil and the end user. You got the transportation, you got the storage. I mean, there's a lot of other things that have to happen that bleed into it. And even if you think, well, oil goes into transportation costs, yes, but those companies that are transporting goods, oil is not their only cost. And oil could be going down, but other costs that they have to pay to deliver merchandise can be going up. And so you can't just say, oh, look, this is deflation because one price is going down. Look, prices are determined by supply and demand on an individual basis. Inflation, when you have a rise in consumer prices, it's a broad-based rise in the general level of prices. But within that, prices can be falling. Look at the prices of computers or cell phones or flat screen TVs, right? All those prices are going down. They're going down a lot, yet the CPI is still going up. While the fact that we're using less oil means that we're producing less stuff. See, a lot of that oil went into the production process. So we produce things using that oil, right? Well, if we're not using that oil, that means we're not producing those things. And so what happens to the price of that stuff that we're no longer making? It has to go up because we don't have any of it anymore because we didn't produce it. Right? And if we didn't produce it, you can't consume it. So oil prices can go down in an inflationary environment. Do not get fooled by what you're seeing in the oil market. Now, of course, the Federal Reserve is going to get fooled. The Fed's going to be thinking, oh, yeah, we can print all this money now. Look, we can offset the weak oil price because we can print more money because there's no inflation, because look at oil prices, instead of looking at why oil prices are going down. It's not like we're now so efficient in producing oil. It's just no one is buying it. And because no one is buying it, nobody is making anything that requires the use of that energy. And so that is inflationary from the standpoint that we're reducing the supply of goods and services that are available in the market to buy. At the same time, we're printing all this money and handing it out, and people are using that to buy stuff. And of course, in the long run, oil is not going to stay down here, right? What is going to happen to the oil market, right? The producers are going to go bankrupt. Now, they would have gone bankrupt a long time ago, and that would have been better, but they were kept afloat by the Fed, and they're still being kept afloat by the Fed, but they're going to sink, right? These companies are going to fail. I mean, I know I invested in some of these companies years ago, right? I know from experience, right, that these were bad investments. These ended up being malinvestments, right? And the Fed made it all possible. A lot of people didn't know early on when the fracking story was new and it sounded very exciting and, hey, let's take a shot at this. but we actually bought into a bill of goods. It didn't really work. Now, the Federal Reserve camouflaged it for a while. They maintained the illusion because these companies stayed in business and they kept pumping and pumping and pumping. And yes, the industry was employing people and it temporarily reduced our trade deficit because we were able to produce oil at a high cost based on a lot of debt, but without any ability. The industry had no ability to withstand this type of decline, right? The oil companies that are going to end up on top are the companies that weren't all levered up, that have the good fields, the good oil that they could produce at a lower cost. They are going to clean up, right? Once the dust settles, once all these high-cost American companies go out of business, they're going to be left to pick up the pieces, and they're going to make a lot of money in the future in the oil market. But a lot of people are going to lose a lot of money right now in the present in the oil market. So long-term, oil prices are going to go up because there's going to be a lot less supply in the future when people want to buy oil.